Morgan Stanley is flip-flopping. I would have not expected this, not at all, but Morgan Stanley's Mike Wilson, the mega bear. Okay, remember, he's the guy who says stocks are going to hell, the recession's going to suck, it's going to be way worse than you expect, and basically anybody who's a bull right now is essentially sucking air on Mount Everest, which is so oxygen depleted that clearly you're getting delusional because you're not able to think clearly because obviously the stock market's going down. That's been Mike Wilson's argument. And I remember I made a video about that Mount Everest piece that he put out, and I thought it was so ludicrous. I thought to myself, holy smokes, the bears are getting delusional. In other words, the bears are starting to run out of crap to say about this economy. Because the reality is, the consumers and businesses have a lot more money than anybody previously thought. And it's lasting a whole lot longer than anybody ever thought it would. So yes, while things are trending bad, we seem to have more fuel in the gas to keep this plane flying for a lot longer than we thought. A lot more fuel in the gas tank. Which would essentially coincide with this idea of, well, maybe the plane doesn't have to land yet, and maybe we can be patient in getting inflation down before markets actually go into that sort of Mike Wilson recession. But anyway, my opinion aside, Mike Wilson actually just changed his tune a little bit, and I'd like to read you a quote. Take a listen to this. Equity markets survived a crucial test of support last week that suggests this bear market rally is not ready to end yet. He specifically pointed out the SPY basically bouncing off of the SMA 200 line, which you could see that specifically here. We've talked about it many a time before, but here's your SMA 200 line, your simple daily moving average. And that 200 daily moving average showed you support at about 390. We ended up getting to a low of about 392 before bouncing off and closing at about 401. Pretty dramatic moves we've seen over here. Anywho, I mean, boy, that is actually pretty dramatic. I mean, if you had a low of 392 and you ended up closing at 401, what is that? 401 divided by 392. Okay, yeah, it's about a 2.2% swing from previous low to next day close. That's not even next day high, which was 404. That's more like a 3.5%. That's remarkable. But anyway, Mike Wilson is now calling this a short-term pivot. He does, however, still reiterate that once the fundamentals deteriorate, then the real pain will come. He says this doesn't change the, quote, very poor risk-reward ratio currently offered by many stocks, given valuations and earnings forecasts that remain way too high. In other words, Mike Wilson is saying, look, people are just going to run out of money. People are going to have money to sustain earnings anymore, and then earnings are going to disappoint, margins are going to disappoint, and you're going to have a pretty nasty crash, and that the real pain is still ahead of us. That's the Mike Wilson point. Now he says the gap between reported earnings and cash flow is the widest that it's been in 25 years, driven by excess inventory and capitalized costs that have yet to be reflected in earnings per share. So in other words, when you spend a bunch of money, but you capitalize it, you basically spread the expenses over time. And so when those spread expenses hit in the future, when people finally stop spending as much money, we're going to hell, is basically what Mike Wilson's trying to say. And now he's trying to hedge his argument that everything's going to hell by basically saying, okay, well, fine, maybe the rally will last a little bit longer, but don't worry, the bear market's coming, I promise. Now, I think that's really interesting because, yeah, they've been, you know, Mike Wilson has been sort of a bear for quite a while. Now, he was right about, you know, the bearishness that we saw last year, but then again, every bear was right last year. At one point, I spent 2 months as a bear. I posted pictures of me skiing last January, and it was basically just a picture of a bear with skis on the ski lift, all alone. A very sad, lonely bear. But what I always like to do is I try to look at some of the other information that we're getting from other analysts, specifically even within Morgan Stanley. I personally wonder if all these people at Morgan Stanley are in the same office and they've like put Mike Wilson in a corner, and then you've got like the level-headed people on the main floor that are kind of like, there's Mike again. Poor Mike. Like, I don't know. And who knows? Maybe he'll end up being right. But here's yet another piece from Morgan Stanley, which is basically the opposite. And what I thought was interesting about this one, and I try to read everything, right? I try to read the bear case and I try to read the bull case. And when I hear the bears arguing that, don't worry, the pain will come, and you must be on Mount Everest because the oxygen's getting thin, it makes me think like, dude, you're running out of facts. And when you're running out of facts to support the bear case is going to go away. Like, so far, people and businesses still have lots of money. And I think that's the big thing that everyone is missing, is just want to just grab them by the shoulders and go, people have too much money. Now, on one hand, that could be really bad because we could actually confirm a meaningful re-acceleration of inflation, right? If the January numbers re-accelerate or continue to prove a re-acceleration here in February with the data we're getting in March, we're screwed. Mike Wilson's going to be right then. Okay, in fact, look, you already know this, right? You already know that coming up, we have a jobs report on the 10th, we got CPI on the 14th, and then we get the Fed on the 22nd. You already know this. But something that we haven't talked about before is that you should not pay attention specifically to those reports. You know what you want to pay attention to? You want to pay attention to the following. The revisions. I want you to look at the January revisions when this data comes out. Pay attention to the January revisions, because here's the best case scenario, in my opinion. Best case. We get the Feb data. The Feb data comes in slightly soft, okay? I mean, the softer it is, obviously, the better. But you want the Fed data to come in soft. But then you want the Jan data to be revised down, because the Jan data was so ridiculous with seasonal adjustments. I'm really hoping for a revision down. Now, I just want to be really clear here before I keep going through this Morgan Stanley piece. If the data for January gets revised down and you get soft February data, I think we break through the next levels of support on the retracement levels for everything. Bitcoin, SPY, tech, Tesla, I don't care what you're investing in. AMC, you know, it's not my fault if you want to invest in bankrupt, in AMC. It's all going up. That would be great. So, revisions, pay attention to those. Really, really important. But what's Morgan Stanley saying over here? So Morgan Stanley suggests that, hey, in the coming weeks, we'll get more data. Duh, we know that. But Morgan Stanley believes right now that the Fed will only require 2 more price hikes or interest rate hikes. Now that's interesting because we've really been talking about this idea of maybe a pause after March until that January data came out. After that January data came out, everybody's like, oh crap, yep, we're going to end up seeing rates go up higher for longer. And so now we're pricing in that hike in May as well. In fact, if we look at futures pricing, we're about a 71% chance of getting a 25 BP hike. Oh, wow, that's actually bullish. And a 28% chance of a 50 BP hike. Now, I think that's ludicrous. I think there's almost no chance we get a 50 BP hike, unless, of course, the data comes in like terribly bad. The data would have to be so bad for jobs and CPI to get a 50, because it would just shoot the Fed's credibility in the foot for what they have left. And then when we look at May, we're looking at probably somewhere between it's about a 95% chance that we're going to be up at 5.25 to 5.5. So yeah, it's actually closer to like 97%. But anyway, pretty much a foregone conclusion that by May we're going to be at 5.25 on the low end and 5.5 on the higher end. That's essentially a foregone conclusion, right? But anyway, what do we have here? So they talk about after these 2 more cuts, they think the Fed will pause. So they're setting this up to say that, okay, June, pause, and then March of next year, that's when they actually think you get your first cut. And you're going to start seeing 25 BP hikes, or cuts rather. Now, this is pretty far out. So what we've noticed is that everything has taken a lot longer than expected, unfortunately. And patience is really, really important in this sort of market. But if this ends up playing out the way it's expected here, as long as people continue to have money to spend between now and then, yeah, we could be okay. In a crazy way, we could be okay to sustain this economy out of a recession. It would be, I'll tell you, like fate loves irony, as Elon Musk always says. It would be the most ironic thing to see that the most predicted recession and the steepest hiking cycle in 40 years does not end up turning into a recession. Jerome Powell will go down as an absolute hero. Now, I've also been reading some Fed papers, and it's important to remember because some people keep talking to me about like, oh, the Fed's definitely going to rug pull us. And I'm like, I don't know, man. The Fed is pretty acutely aware of the pain that their activity causes. In fact, let me get to the conclusion on this paper. I was just reading this morning. Here, look at this. My favorite line was actually right here, where they said, such policies, in other words, so they talk about keeping rates for too low for too long, blah, blah, blah. But anyway, if you create the risks of financial crises, then you want to avoid creating the risks of financial crises because of the social, political, and economic costs that come with them. And I thought that was fascinating because it really shows sort of the Fed's awareness. This is a Fed paper, by the way. It shows the Fed's awareness of look, you know, if you tighten too hard, people lose their jobs, people go bankrupt, you ruin businesses that potentially could have otherwise thrived. So you really impact humans. You create misery and depression and increase suicides, right? Like, it's terrible to put people through a nasty recession, right? This is the Fed themselves does not want to have to pull Volcker us because the costs are too high. It also hurts our standing of the US dollar. And then, of course, it hurts the long-term economic prosperity of America as well. Anywho, continuing on here, Fed has made less progress towards disinflation than previously thought. For any additional insight into the May meeting, we would need to see the evidence that the re-acceleration is real. This is basically saying, look, for us to even remotely think we're going to end up getting 50 BP, we're going to have to somehow prove that, oh yeah, everything's re-accelerating. And even if you look at Costco's earnings call from the second, you're not, look, you're obviously seeing that prices have gone up. But they're not meaningfully continuing. In fact, most companies, even Costco, aren't talking about more future, hikes for wages. Instead, what are they talking about? They're talking about autonomy and efficiency. I'll just read it to you because I'm not making this up. Look at this. Notwithstanding the 2 to 3 off-season wage increases we had over the last 15 months, which has impacted some slight deleverage. Deleverage, basically, this gets a little complicated. Deleverage means basically their OPEX and their cost of goods sold went up a little bit higher than the rate that revenue increased. So notwithstanding this information, given that we've only slightly deleveraged is actually pretty impressive, given that labor is our biggest expense. So then what do they talk about? They don't talk about more wage increases. Instead, they talk about it's our productivity. We're getting better at productivity. And then over here, you have an analyst that's saying, so if compensation is rising 6% and inflation, like nominal prices, are going up 6% for goods, but traffic is only up 3%, then that means you should be seeing revenues down 3%, right? He's basically saying 6 and 6 with offset by 3 should be a -3, right? And they're responding, well, people are spending more money on more expensive things, so not necessarily. In other words, not simply price inflation, it's mix. Now, mix is a really important phrase to remember when you're talking about finance because it's basically saying people are buying higher margin items at Costco rather than somewhere else. So that's good. That's a benefit to Costco. That actually shows some level of pricing power that can increase average selling prices. They're not actually just talking about increasing prices. In fact, when they're asked about the elasticity of price, they say, well, we don't really analyze price elasticity. We basically just focus on this. If we lower prices, we do more sales. So I think it's really interesting because if you go through the earnings call, and I'm just going to sum it up because it's a little arcane, but if I make it simple, the simplest way to put it is Costco is telling you, in my opinion, basically the same thing that almost every other company is. They're telling you, look, yeah, we had to raise prices, but you know what we're doing now? we're focusing on the fact that if we want more revenue, we could lower prices. If we want more margin, we focus on productivity and automating. That's really what you're seeing at almost every single company that I've been analyzing. I'm trying to find where that automate. Here it is. Oh, found it. Look at this. So inflation has gone up. We know that. It's gone up in the past. We know that. And I think the focus now, this is important now, what do they focus on? Is trying to figure out how to do things more efficiently. One of the things we do religiously every 4 weeks at the budget meeting is the operators are talking about certain focus items, whether it's improving overtime hours, in other words, cutting those, or things we've done to automate something physically, improving the flow of goods in the warehouse. So, what is pretty much everyone talking about? Everyone's talking about efficiency, automating, becoming more productive. That's what everyone's talking about. Nobody's talking about, hey, we still got a lot more, wage inflation to pass on. We still got a lot more price increases ahead of us. And if anything, they were like, yeah, look, if we want to increase revenue, we could just cut prices. In my opinion, that's actually very bullish. And it's very bullish because it shows, even though we're going to go through some volatile hell over the next bit here, it's very bullish because the last thing you want is evidence that companies are starting to make you think Paul Volcker's coming, right? This is stuff we look at almost on a daily basis in our course member live streams when we do fundamental analysis. We try to understand what kind of pricing power do companies have. I encourage you to join those, by the way. Any of the programs comes with lifetime access to the course member live streams. But anyway, to me, this is fantastic. This is very good. It's also fantastic that Goldman Sachs, for the first time ever, has just turned bullish on Apple, saying it has a 32% upside from here, $199 price target. They talk about Apple's widening and increasing install base, basically leading to this moat of people not leaving Apple. Really, the more people they Venus flytrap in, the better. That was pretty interesting. So we'll see. But pretty excited about that. I know some people here say things like, Paul Volcker can't save us either. I mean, what I always respond to stuff like this is, hey, what evidence do you have? Like, where is the bad? Because I'm looking for it. And people send it to me, and then I make a video on it explaining how what they think is bad is actually not that bad. It's all like, usually the bear argument is, well, but prices are still up like 10%. I'm like, yeah, no shit. That's how inflation works. Stuff gets more expensive. Done. What matters is the stickiness of that, right? So, Someone here writes, Costco croissants are so good. Wow. Yeah, you mean like in the white clamshells that were the clear clamshells where you kind of get like that giant box, right? Sup, Investment Joy? What's up, man? Investment Joy, I love this guy. I got to come back to Chillicothe and visit you. Super curious what happens if rates hold with 32 trillion debt. You can't tax your way out of a $1 trillion debt service. Yeah, here's the, and it's totally understandable because central banks are losing money like hand over fist right now because the yields they're getting on their investments are substantially lower than what they're having to pay out in the overnight repo facility. And really what happens is that's where politicians sort of just basically write a blank check to print more money and offset those losses. Now, that sounds ironic because it's sort of like, hey, but if you print more money, doesn't that create more inflation? Not necessarily if that money isn't being then circulated through the economy, if it's just going to sort of potentially pay off this deficit that the Fed has created. And the idea there is, well, then won't people lose trust in the institution of America? Well, yeah, eventually. I mean, at some point in the long term, every currency generally tends to go to zero because its government loses power and trust. But in the near term, I don't think it's likely that that's actually something that's going to, sort of destroy our economy. I think people are so much better off today in aggregate, not everyone obviously, than they were before the pandemic. That really, once we get back to a normalized economy, I don't think that markets will terribly care about the rejiggering that happens at the Fed. Don't get me wrong, there'll be some fun things that are going on over there. But another thing to keep in mind, too, is that not every set of interest or debt, essentially the bond or our government has is attached to the interest rates that are being paid today, right? So you got two institutions. You've got our government, and then you got the Fed. The Fed is paying money hand over fist in the repo facility. Like, they're losing money, right? The government has a lot of their debt that needs to roll into higher yielding debt. And so it basically means the average interest paid is actually still very low for the US government. In fact, if you look at, here, we can look this up, St. Louis Fed debt payments as a percentage of GDP. It's still lower than where we were in the 90s. Interest as a percentage of GDP. All right, so look at this. This chart goes all the way back to the 1940s, right? So going back to the 1940s, what do you have over here? You actually have in the 1990s, our interest rate or the interest we were paying as a percentage of GDP was basically around 3%. So in other words, we're paying 3% of our GDP towards interest. Right now, we're only paying about 1.86%, or roughly half of our GDP in interest. Now, that is expected to go up. But even if it goes back up to the 90s, did we really have an economic calamity in the 90s? Not really. In fact, many say 1994 was really aligned with a soft landing. Yeah, you had a technical recession in 91, but it's not one anyone ever talks about because it's really not that big of a deal. So I think that's pretty fascinating. So we'll see. Hey, thanks so much for watching and subscribing, as well as sharing the videos. In case you've enjoyed it, make sure to consider getting more perspective via the links down below in becoming a millionaire through real estate investing. It's one of our most popular courses, 0 to Millionaire Real Estate Investing. That is often bundled with the Stocks and Psychology of Money group or the Do-It-Yourself Property Management and Rental Renovations Guide. After that, you can also check out the Elite Hustlers, which has its own special exclusive live stream for people looking to make more money as an individual earner, or that is as an entrepreneur, or as an employee. And of course, check out the other programs specifically for agents or YouTube content creators.